All right, with the Fed on the offensive, there seems to be plenty to bet against in this market, at least according to our next guest, famed short seller Jim Chanos. He's the founder of Chanos & Company. Joins me now. It's good to see you. Welcome back.
Good to be back, and congrats on the new show.
No, I appreciate it very much, and it's good to have you in the earliest days. It's been an interesting start to the year, to say the least. I'm wondering how somebody who sits in the seat you do, looking at the kind of stocks I know you do, how you would view how we've gotten here to start the year and the things that have led us.
So if we go back to the beginning of the year, Scott, there were three sort of givens that the market, via market pricing, was discounting. It was looking for 12% earnings growth this year. It was looking for a reduction of inflation to 2 to 3% by the end of the year. And it was looking for Fed ease in the second half of the year. Two of those three are gone as of mid-February, the inflation outlook and the Fed. Investors are still pretty sanguine on earnings, however, but very interestingly, earnings estimates for the S&P, bottoms up operating earnings, have been coming down about $1 a week since the beginning of January. So at the beginning of the year, people were looking for about $227 in the S&P. And today they're looking for $220. Now, the good news is they brought down fourth quarter numbers too, so to $196. So we're still looking at like 12% growth. We're just getting there kind of the wrong way by shrinking both the numerator and the denominator. So, we don't have a view on the market per se. We're pretty much always hedged. But, things are not cheap. I've said that for a while. And we continue to see rallies being led by lower quality stocks. That was certainly the case in January, similar to October, similar to August, similar to last March. And so we get these sort of relief rallies. People cover shorts, chase momentum, and then things sort of sort themselves out. So that's about the best I can do for you.
Are you more aggressively, though, positioning for more downside in the things that you are betting against?
We're about the same as we were coming into the year. Our shorts have a higher beta than the market, so we're adjusted for that. We're probably 80-some% invested, which is where we were coming into the new year. Don't worry, it gives us plenty of chills and spills in the portfolio, though. That's for sure.
Let's talk about a name that I believe is still in your portfolio on the short side. That is Coinbase. Yes, you're still short?
We are still short.
Okay, so obviously we had the earnings yesterday, and I'm curious your read, obviously, for a stock that, was down so significantly last year, but up so dramatically into the report. How do you view it?
Yeah, so Coinbase is a wonderful example of what I was just talking about. I mean, it had a number of very similar rallies last year, and throughout late 2021 and throughout 2022 and into 2023. These 50 to 100% rallies are not new to Coinbase because it's a narrative stock. It's not a fundamental stock. And by that, I mean people buy it because they have a view on crypto prices or crypto survival or what have you. And the fact of the matter is, as we saw last night, is Coinbase is still losing money. And I kind of quipped last night, if not now, when, right? We've had a 40 to 50% crypto rally in 2023. You would think retail investors would be leading the charge. But I think you actually pointed out before the results that it was apparent that retail was not leading the charge into crypto. And Coinbase's results last night, where they indicated trading revenues of about 120 million in January, which would be 360 million for the quarter, is not much above the 322 in trading revenues they did in the fourth quarter. Mm-hmm. So what's intriguing to us, Scott, is where they're making more money. Remember, they're losing money, of course, but they're making it in two areas. One, they actually raised commission rates for retail effectively in the fourth quarter. Round trips for the fourth quarter were costing retail investors 3%. up from 2.7 in the previous quarter. So they actually somehow raised commission rates on their customers, which I think is going to go against the grain of things like your friend Josh Brown discussed, which is as Fidelity and Vanguard and others get into this business, commission rates are heading down. And number two, they're not paying interest on customer deposits. That was a huge source of interest income in the quarter. And I just don't think that's a sustainable model as we go from 0% interest rates to 5% interest rates. Not paying interest on customer deposits will also be competed away, in our opinion.
I feel like a key thesis, or the key part of your original short was based on fee compression, the likes of which you're talking about now, which they suggest are not being seen to this point. I'm wondering if you now think you may be right directionally about the stock, but in a sense for the wrong reasons. The right reasons being that retail is sort of exit stage left from crypto right now. There's obviously a lot more regulatory scrutiny from the SEC on this company, but the key part of what you thought was going to take place hasn't really happened yet.